You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, so we had a very volatile tweet week in the markets. We are taping Options Playbook Radio today on Wednesday, May 8th. The markets have closed. The biggest number for me today is to actually look at the VIX index. There's really not supposed to be much going on, but the VIX is trading at 1940. It was up 8 ticks today on the marketplace, but it really has made the big run up on Monday and Tuesday. Those were the big days for the VIX index. Market has tanked quite a bit. Today it actually closed, the S&P 500 index was down 4.63, closing at 2,879.42. So not quite as big of a down day as the last couple of days, but it is still a down day. VIX is definitely inflated. Donald Trump and China are going to, well, I guess the United States and China are going to be meeting up this week at the end of the week to talk about trade talks and tariff discussions. And that's the main reason why the VIX is staying so inflated, even on a little tiny down day. So when the VIX is inflated, I like to sell stuff. And it's, as always on Options Playbook Radio, nothing is meant to be a recommendation, but we always just want to look at different market conditions when you might do this trade versus that trade. And we've done a few trades and with fairly decent paper trading success here on Options Playbook Radio, looking at doing long call spreads with an alternative of turning them into a butterfly. So for example here, what we're going to do with the market trading at in the S&P 500 index at 2,879.42, we're going to use the S&P 500 index option contracts, and we're going to sell some at-the-money option premium. If I look at the option chains, the 2-day option contract, that means it's got all day Thursday, all day Friday to trade. At-the-money option, because of the 19% implied volatility, is trading 24.40 by 25.10. So basically $25 for one option contract that is 50 cents out of the money in this instance. So as most of you know out there in Options Insider Radio land, that value's got to go away by Friday. If the markets stay right where it's at, that $25 option has to trade for zero. So we're going to sell it. Why not? You got 2 full days of trading, and then we just don't want to be naked in this marketplace. So our main goal is to try to capture as much of that premium as possible. So we're just going to go 5 points down, and we're going to buy the 28.75 call. And that is trading, market is 27.60 on the bid by 28.30 on the ask. So the midpoint for this trade with 2 full days of trading is at $3.20. So the market is pretty much right at 28.80. We're doing a 5-point wide spread, and the maximum risk for that 5-point wide spread is $3.20. The maximum upside is $1.80, and we just need the market to stay where it's at or drift higher over the next couple of days. More than likely, it's probably going to make a decent move tomorrow, but the big talks are on Friday. And a lot of this time decay has to start eroding by who knows when they're going to announce anything and what could happen by then as far as the tweet rant going on by Donald Trump and what his thoughts are going into the Friday meetings. But with that said, we're going to try to take advantage of that some of that premium. So in this scenario, we're going to go out and buy the May 10 2-day to expiration, 2 full trading days, 28.75 call, and at the same time sell that same expiration, 28.80 call. The market's at 28.7942. We're going to try to execute this for a paper trade midpoint of $3.20. Means for every 1-by-1 spread, our maximum risk is $320. Maximum upside is $1.80. Now, so that erodes fairly quickly if the market opens up tomorrow, and even opens up 5 or 10 points. We're going to start seeing some erosion inside, especially if we can get volatility to go along with the time decay. More than likely, the volatility is probably going to come out on Friday at some point in time. Time decay obviously has to come out at some point in time. But that's the simple solution. If the market goes up, this trade is very easy to manage. On the downside, if the market goes against us and it opens down 5 or 6 points, what's kind of crazy overall is that if you look at a butterfly using these option contracts, but we're going to add a leg to it. So the butterfly right now, if you bought the 28.75, the option contract we were talking about, May 10th expiration, sold 2 of the 28.80s, and then bought 1 of the 28.85s, basically made this all about 28.80, keeping the stock right there. That's trading at the midpoint for a debit of 15 cents. That's 1.5. That would be your maximum risk, would be $15 for 1 butterfly. And then your maximum upside would be the $5 minus the 15, or $4.85. Now, that is a very inexpensive butterfly, but the odds of the market staying within 5 points of where it's at to the downside or to the upside, or a 10-point swing, if you will, in total, I think are a little bit slim going into this big Friday event. But we're going to use this concept of the butterfly as, I don't want my cheese anymore, just let me out of the trap. So if the butterfly's trading for 15 cents, that means that if you sold the credit spread, just the second half of the butterfly, because we're buying the first half as our paper trade this week, the long spread, and we're selling the short spread. Well, that could be done for a net credit of $3.05, hence bringing in the total debit of the butterfly to 15 cents. So what we're going to do is say we're willing to wait a little bit and see what happens. And if the market opens down tomorrow 5 to 10 points, or let's say the credit spread is trading for a net credit of around $2, that right now is trading for $3.05, then we're just going to roll into the butterfly. So it's all going to be based off of price. Let's say we executed at that midpoint of $3.20 on the long spread from the 28.75s to the 28.80. Then we're just going to keep an eye on the 28.80, 28.85. And if the market opens up, no worries. We're not going to even touch that spread. But if the market opens down 5 or 10 points on Thursday, we're just going to take some of the risk off the table by selling the credit spread. And ideally, I'd probably put an alert to let me know if that credit spread is trading for a net credit of $2 as opposed to the $3.05. And if that's the case, then I'm going to think hard about selling it. And time decay and volatility, there's a lot going on here. And if I can sell that and make my maximum risk of this entire position $1.20, let's say I execute that spread, the market opens down, I execute that spread for $2 in that instance. That means my total risk would be $1.20, and then I still got the chance that the market might come back to 28.80 and settle somewhere in between that 10-point swing. So if I'm looking at it this way, I'm basically saying I don't want the cheese anymore, just let me out of the trap. I think the market might have a little bit of upside on it or neutral basis going into this Friday event. And if that does happen, great, my long spread's going to pay me out. But if it comes down, I got a plan. I got an idea to try to salvage the position or maybe even make a profit. So that's basically the trade. It's a two-legged trade. You can almost say that this is really about the butterfly, and it's all about the VIX being at 19 and staying at those lofty levels. So with the VIX at 19, let's recap. The initial trade that we're looking to do, market is closed right now. We are on Wednesday, the 8th of May. Markets are closed. The S&P 500 index traded at 2879.42, down $4.63. The VIX index is north of 19 at 1940 right now. We're looking to do a 2-day trade and buy the 2875 call and at the same time sell the 2880 call, executing a long call spread done for a net debit of $3.20 to your account. So your maximum risk would be $320 plus commission. And if we're wrong and the market goes down, it doesn't stay flat or drift up, then we're going to go and roll into a butterfly, and we do that by selling another one of the 2880 calls and then buying the 2885 calls as a hedge. Looking to do that if that net credit is somewhere around $2. It's currently trading for $3.05. That would mean that the market has gone against us. That's it for this episode of Options Playbook Radio. If you have a topic you'd like to discuss on the show or a question you'd like us to answer in the program, you can send them directly to me at theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.